know that feeling. The first of the month. You pick up your phone. And there it is, salary credited. 42,000 rupees. You smile for about 4 seconds. Then the EMI notification arrives. Then the rent reminder pops up. Then your mother calls asking about the family wedding contribution. And just like that, in under 3 minutes, 42,000 rupees feels like 6,800 rupees. But here is the question you have never asked in that moment. Not where did the money go? Where did the money come from? Not who transferred it. You know that. Your company did. But where did your company get it? Where did the bank get it? Where does any money, anywhere, actually come from in the first place? Because what I am about to tell you will completely change how you see every salary notification, every bank balance, every UPI transaction. For the rest of your life. Most money in existence was never printed by anyone. It was created out of nothing by a private institution, using a mechanism so quiet, so elegant, and so perfectly legal. It has been running for over 300 years, and almost nobody outside a university economics class knows how it actually works. You are about to find out. Let's be honest about what your mental model of money looks like. Government needs money leads to tells the RBI leads to RBI prints notes, leads to money enters the economy. That's what most of us picture. It's clean, it's logical, and it is almost completely wrong. Yes, the RBI does print physical currency. Those 500 rupee notes in your wallet, the 100 rupee note you gave the auto driver this morning, those are real printed physical objects. The RBI is responsible for those. But here is the number that breaks everything you thought you knew. Physical cash, every note, every coin in India, makes up only about 3% of all the money in the entire economy. 3%. The remaining 97% of all money in India exists only as numbers on screens, digital entries in bank databases, balances that get transferred, borrowed, and multiplied, but never physically touched, and almost none of that 97% was printed by the government. So the question is, if the RBI didn't create 97% of India's money, who did? Let's follow a single rupee and watch what the banking system does to it. Your father worked hard his entire life. He saved 1 lakh rupees, carefully, over years, and one day he walked into his local bank and deposited it. He felt responsible. He felt safe. He felt like he had done the right thing. Now, what does the bank do with your father's money? If you said, keeps it safe in a vault until he needs it. That's what the bank wants you to believe. That is not what actually happens. The bank is legally required to keep only a small fraction of every deposit in reserve. In India, this is called the cash reserve ratio, the CRR, currently around 4%. So on your father's 1 lakh rupees, the bank keeps 4,000 rupees in reserve. And the remaining 96,000 rupees, it lends it out. Your friend needs a business loan. She borrows 96,000 rupees from the bank. She deposits it in her own account to pay her suppliers. Now, this is the moment everything changes. That 96,000 rupees is now a deposit in the banking system again. Her bank keeps 4% in reserve, lends out the rest. That money gets borrowed by someone else, deposited again, lent out again. By the time this chain runs its full course, your father's original 1 lakh rupees has become approximately 25 lakh rupees in total deposits circulating through the banking system. Your father can log into his app right now. It shows 1 lakh rupees. His money is there. But that same 1 lakh rupees is simultaneously the foundation for 25 lakh rupees worth of loans circulating in the economy. This is called fractional reserve banking. And this, not the RBI's printing press, is how most money in India is created. Every time a bank approves a loan, it is not lending out money that already existed somewhere. It is creating brand new money in that moment. With a few keystrokes. Think about the personal loan you took last year, or the credit card limit your bank keeps offering to increase. That money did not exist before the bank approved it. It was created the moment the transaction was confirmed, and it will be destroyed, literally removed from existence, the moment you finish repaying it. Now, I can feel what you are thinking right now. If banks can just create money from nothing, why don't they create unlimited money and make everyone rich? That is exactly the right question to ask. And the answer to that one question explains everything. Why your grocery bill keeps rising. Why your rent goes up every year. Why financial crises happen. Why the RBI raises interest rates and your EMI suddenly increases. All of it, explained by one answer. But first, we need to understand what actually limits money creation. Because once you see these limits, you will never read an economic headline the same way again. Stay with this. Banks can create money, but 3 things stop them from going infinite. Limit 1. The RBI. The Reserve Bank of India is the gatekeeper of the entire system. The CRR reserve requirement is one lever. It sets the minimum fraction banks must hold back. The repo rate is the bigger lever. When the RBI raises the repo rate, borrowing from the RBI becomes more expensive for banks. Banks pass that cost to you. Your loan becomes costlier. Fewer people borrow. Less money gets created. When you read RBI raises rates to fight inflation, what it actually means is the RBI is turning down the money creation tap across the entire economy. And when you feel your home loan EMI go up, you are feeling that tap being turned. Limit 2, your willingness to borrow. Banks can only create money when someone takes a loan. If you are scared, and if your colleague just lost his job, if the economy feels uncertain, fewer people borrow. Less money gets created. The economy slows down. This is why recessions are self-reinforcing. Fear leads to less borrowing, leads to less money in the system, leads to less spending, leads to more fear. Your confidence, and your father's confidence, and your colleague's confidence is literally a variable in India's money supply. Limit 3. Trust. This is the most fragile limit of all. Your father deposited 1 lakh rupees. But that 1 lakh rupees is now the base for 25 lakh rupees circulating in the economy. If tomorrow morning your father, 10% of other depositors, walked into their banks asking for their cash at the same time, the bank cannot pay. The physical money does not exist. That is a bank run. You saw echoes of it during the Yes Bank crisis in 2020. You saw what happened outside PMC bank branches in 2019. People who had done nothing wrong, suddenly unable to access their own money. This is not a bug in the system. This is the system. It is deliberately designed this way because it allows the economy to grow far faster than the physical supply of gold or printed notes would ever allow. But it also means the entire financial architecture of modern India and every country in the world is built on one thing: collective belief. The moment enough people stop believing, the architecture shakes. You're looking at your phone again. Salary credited. 42,000 rupees, but you are seeing it differently now. That 42,000 rupees did not come from a vault. It did not come from a printing press. It exists because somewhere in this chain, a bank approved a loan. Your company borrowed to make payroll. That borrowing created money. That money landed in your account. You are not outside the system. You are inside it. You always were. And here is what this understanding changes for you right now, practically. 1. Inflation is not bad luck. It is arithmetic. When too many loans are created too fast, too much money chases the same number of goods. Prices rise. The purchasing power of your salary falls. You did not get poorer because of bad fortune. You got poorer because the money supply expanded faster than the real economy could keep up. 2. Your EMI going up after an RB. A rate hike is not random. The RBI is not punishing you. It is trying to slow down money creation to stop inflation from running further. You are caught in the mechanism. But now you understand why the mechanism exists. 3. That pre-approved loan. SMS at 11 p.m. is not a favor. When your bank offers you a 2 lakh rupees personal loan with one click, it is not helping you. It is creating 2 lakh rupees of new money, on which it will earn interest, on money it conjured from nothing the moment you said yes. That is not a moral judgment on the bank. It is simply how the system works. But knowing it, really knowing it, means you never borrow casually again. Here is the one line I want you to carry with you after this video. Money is not a thing. It is an agreement. It is an agreement between banks, governments, and ordinary people, like you, like your father, like your colleague, that the numbers on your screen represent real value. That they can be exchanged for food, housing, time, and human effort. The system works because everyone believes it works. It has worked, mostly, for 300 years. But the people who understand how the agreement actually functions, who writes the rules, who benefits from them, how money is born and how it dies, those people are never surprised by inflation. They are never confused by a financial crisis. They are never caught off guard by a rate hike. They see the machinery. And once you see it, you cannot unsee it. You picked up your phone this morning and saw a number. Now you know what that number actually is, and that changes everything. If this video made you see your bank account differently, share it with one person in your life who still thinks the RBI prints all the money. They deserve to know what you just found out.